When financial experts start whispering about inversions, most people tune out. It sounds abstract, something for economists and traders, not for the rest of us trying to pay rent or keep the lights on. But every time this quiet signal appears, it's like feeling a deep vibration under the ground before an earthquake. You can't see it. You can't stop it. But if history has taught us anything, you'd better pay attention. The yield curve has predicted every major recession for the past 50 years. Not some of them, all of them. And right now it's screaming louder than ever. But here is what most people miss. A yield curve inversion doesn't just warn Wall Street. It warns you. It's the reason your boss suddenly talks about budget adjustments. It's why your local store starts cutting hours, or why your rent rises faster than your paycheck. It's why your neighbor who just opened a small cafe says traffic's been down for months. The curve bends long before lives do. And by the time we feel it, it's already too late. Let's start with what it actually means. Government bonds are supposed to work like this. The longer you lend money to the government, the higher interest you get. It's common sense. If you're locking up your cash for 30 years, you deserve more than someone lending for 2. But when that natural order flips, when short-term rates rise above long-term ones, the financial world tilts upside down. It's like water flowing uphill. Something's wrong. Investors are so afraid of the near future that they're willing to accept lower returns for long-term safety. It's a mass panic disguised as a technical indicator, and every time that panic reaches critical mass, the economy breaks within 18 months. In 1929, the curve inverted in early 1928. The stock market was a fever dream. Everyone thought prosperity was endless. The Federal Reserve tightened policy, trying to slow an economy built on speculation and borrowed money. Banks lent to anyone with a pulse. Ordinary Americans, farmers, barbers, teachers, bought stocks on margin, believing they'd found a magic machine for wealth. The inversion was the system's way of whispering, "This can't last." 18 months later, the whisper became a scream. Black Tuesday hit. Fortunes vanished overnight. But here is the part the history books forget. The crash didn't just take the rich. It took the baker who couldn't sell bread because no one had coins left. The shoemaker who watched customers walk barefoot rather than pay. The young couple who lost their home, not because they gambled, but because the factory where they worked shut down after its loans were called in. Every graph on Wall Street was a family table gone quiet. Fast forward to 2006. The yield curve inverted again. This time, the fever wasn't stocks, it was housing. Everyone believed property only went up. People bought homes they couldn't afford. Banks packaged those mortgages into complex securities, wrapped them in promises, and sold them like candy. The inversion flashed red, but nobody cared. The profits were too sweet, the language too complicated for the public to understand. When the bubble burst in 2008, it wasn't just bankers jumping from skyscrapers. It was single mothers losing homes, retirees losing savings, college grads realizing their degrees meant nothing in a frozen job market. And yet, the system was saved. At least, that's what they told us. The Federal Reserve printed trillions, slashed rates, and called it a rescue. But for most people, it didn't feel like salvation. That felt like survival, harder, thinner, lonelier. Now the curve has inverted again. It started quietly in 2022, while the world was distracted by wars, elections, and rising prices. The same forces that broke 1929 and 2008 are back. Only now, they're fused with something far more dangerous: technology, globalization, and a level of debt that makes the past look quaint. Consider this. In 1929, total US debt was manageable. In 2008, it had ballooned but was still measurable. Today, we're beyond measure. Government debt, corporate debt, household debt, student loans, credit cards, the numbers are so big they've lost meaning. You could add them up, but they wouldn't fit on a screen. And beneath those numbers are people, millions of them. The grocery clerk maxing out her credit card to buy food because her paycheck no longer stretches through the week. The delivery driver juggling 2 jobs and still behind on rent. The small business owner drowning in interest payments that rise faster than revenue. In textbooks, they call this systemic risk. In real life, it's exhaustion. After 2008, central banks printed money like rain. They called it quantitative easing. But what it really did was feed the rich and starve the middle. Real estate prices exploded, stock markets soared, corporate profits hit records, and wages, they crawled. The yield curve inverted again because deep down, the market knows this is unsustainable. The game has gone on too long. We've built a tower of promises on a foundation of IOUs. But here's the cruel twist. For most people, it doesn't look like crisis. It looks like life. The rent's high, the bills never stop, the groceries shrink in size while prices grow. You don't think macro trends. You just think, why does everything cost more? The yield curve doesn't just chart money, it charts trust, or the loss of it. Each inversion is a measure of fear, the kind that starts in the boardrooms but ends in the break rooms. It's the fear that makes companies freeze hiring, that makes workers take gig jobs instead of full-time ones, that makes parents skip savings because survival comes first. And while analysts argue on CNBC about basis points and bond spreads, the curve has already begun its quiet work, draining optimism from small towns, tightening credit for local businesses, and turning ambition into anxiety. That's the part no economist models, the human lag. Numbers change fast, people break slow. In the coming months, you'll hear experts debate whether this inversion really counts, whether the economy is strong enough to weather it. They said the same in 1928, they said it in 2006, they'll say it again now. But beneath the statistics, the signs are already here. Job postings quietly vanish, startups fold, families stop eating out. The curve has spoken, and history says it never lies. The question isn't whether a storm is coming. It's whether we're ready to admit the sky's already darkening. Because while the traders stare at their screens, ordinary people are already feeling the tremors in their wallets, their workplaces, their homes. The ground is shifting again, and this time it might not just crack the market, it might break the illusion that the system was ever safe to begin with. The last time the yield curve screamed like this, millions lost homes. The time before that, they lost everything. And now, it's whispering again, not to Wall Street, but to the world that feeds it. Because the truth is, recessions don't start in trading floors, they start in grocery aisles, in small-town diners that used to stay open late, but now close before dark to save on electricity, in factory lines where machines hum a little slower, not because they're broken, but because there aren't enough orders to fill the day. That's how the next collapse begins, not with a bang, but with 1,000 small silences. The Federal Reserve can flood the markets with money, but it can't make people feel safe enough to spend it. It can cut interest rates, but it can't cut fear. And fear is what drives every recession, not numbers on a chart, but the collective decision to hold back, to wait, to stop believing that tomorrow will be better than today. In 2008, that fear spread through neighborhoods like a fog. People skipped breakfast to pay the mortgage. Small business owners stood in empty shops, watching dust collect on unsold goods. Construction workers packed their tools and went home, not knowing if they'd ever need them again. We like to think that crisis is a headline, something that happens once then ends. But for ordinary people, it lingers. The crash never really leaves. It hides in credit card statements, in the second job you take, just for a while, in the vacation you cancel because it's not the right time. Now in 2025, the warning signs are multiplying again, and this time there's nowhere left to hide. The yield curve inverted in 2022, and the world kept going. Markets hit new highs. Politicians called it resilience. But resilience is a word the rich use to describe other people's suffering. What really happened was that debt disguised decay. Every new loan delayed collapse. Every printed dollar postponed the truth. We are living in the hangover of cheap money, a decade where everything, houses, education, healthcare, even hope, was financed on borrowed time. The problem is that borrowed time always comes due. For the average worker, that due date feels like this: rent up 40%, wages up 4%. Groceries double, savings disappear. You do everything right. Work hard, save a little, pay your bills, but somehow you still fall behind. That's not bad luck. That's the system working exactly as designed. And when the curve flips, it's that system admitting, even for a moment, that the illusion can't last. But what makes this time truly dangerous isn't just the inversion. It's what comes after it, the collapse of faith. You can measure a yield curve with numbers. You can't measure trust. Yet trust is what holds the economy together. The belief that your paycheck will arrive, your savings will mean something. Your bank will honor your card when you swipe it. The belief that the rules apply equally to everyone. That belief is eroding faster than any interest rate can track. In 1929, when the crash came, people lost money. In 2008, they lost confidence. In 2025, they might lose patience. Because for the first time, the crisis isn't confined to banks and hedge funds. It's in the apps that deliver our food, the gig jobs that pay us by the ride, the invisible digital systems that decide who gets a loan and who doesn't. The entire economy has been rebuilt on code and credit, and both are fragile. When a small business misses a payment, its supplier feels it. When that supplier delays wages, a family cuts spending. When enough families cut spending, the numbers on Wall Street begin to tremble. Then the panic spreads back through the same wires that carried the optimism. This is how economies break now, not through a single crash, but through a synchronized slowdown that feels like exhaustion. The average household doesn't see a recession as GDP contraction. They see it as the fridge getting emptier. The boss saying, "We're cutting hours." The credit card minimum payment inching higher every month, and yet the government will tell them the economy is strong, because unemployment numbers look fine, on paper. They won't mention that millions have stopped looking for work entirely. They won't show the full-time worker now driving for Uber on weekends just to cover rising bills. They'll say inflation is under control, even as people quietly stop buying meat or delay doctor visits to save on co-pays. That's what an invisible recession looks like. It's not a line on a graph. It's a family sitting at a table, pretending everything's fine while counting how many days are left before rent is due. Meanwhile, the system that caused all this keeps doubling down. Corporations borrow billions not to innovate, but to buy back their own shares. Governments spend trillions to appear stable. Central banks tweak rates like surgeons working on a dying patient who has already lost too much blood. And somewhere in that chaos, the yield curve bends, the last honest signal in a world built on noise. When the curve inverts, it's the market's way of confessing that it no longer believes the story. That no matter how many press conferences promise soft landings, the landing will still hurt. What makes this even more tragic is that people no longer expect fairness, only survival. Workers know their pensions won't last. Young people know home ownership is a fantasy. Parents know their children's future will be smaller, tighter, and more expensive than their own. That quiet resignation is more dangerous than panic. Because panic ends. Resignation becomes a culture. And when a culture stops believing in tomorrow, the economy dies, slowly, politely, without the drama of a crash, but with all the pain of a decline you can feel in your bones. The yield curve doesn't predict this kind of collapse. It merely warns that it's begun. If 1929 was the fall and 2008 was the warning, then 2025 may be the reckoning. Not just of markets, but of meaning. Because a society that measures everything in profit eventually runs out of things worth selling. You can already see the fractures forming, strikes spreading across industries, small business bankruptcies rising, young workers leaving cities, retirees returning to work not because they want to, but because they must. The system didn't just run out of money, it ran out of mercy. The curve's inversion is just the symptom. The disease is inequality, exhaustion, disconnection, a financial world that no longer serves the real one. And yet, in every collapse, there's a strange clarity. When the numbers stop making sense, people start looking for what does. Neighbors help each other again. Communities trade, share, repair. Old skills return. Local becomes survival. Maybe that's the lesson hidden in the curve, that every empire built on credit eventually returns to something simpler, something honest. When the next crash arrives, and it will, the question won't be how big it is. It'll be how many people still remember how to stand when the floor gives way. Because history isn't repeating itself. It's rhyming louder. And this time the warning isn't for the bankers or the traders. It's for the teachers, the builders, the drivers, the parents, the ones who keep the real economy alive long after the spreadsheets have burned. The yield curve doesn't lie. It never has. And if you listen closely, beneath the noise of politics and promises, you can already hear what it's saying. The sound isn't panic, it's inevitability.